Hey guys, John Polemy here, Actionable Intelligence. Today's Monday, November 19th, 2018, and this is the weekly report. It's a couple days late, obviously. I was on vacation in Chicago with my family, taking in the sights, but I did say that I wanted to get out a update, especially on the oil market. So this whole report will be basically talking about oil and the recent huge drop in oil. So let's get right into it. Okay, so I've identified several reasons why we had the recent huge avalanche slide in oil prices. This is the time when these type of things happen, when it's gut check time, whether or not you're a contrarian speculator or whether you're just somebody that gets ran out of the market. So let's think logically and look at the facts and talk about what really happened here. Okay, so I've got four reasons here why the oil price slide occurred over the last month. Number one, U.S. shale production keeps growing and set new record. The United States is now the largest oil producer in the world. I've talked about shale before. In the context of 100 million barrels per day demand, we're producing close to 12 million barrels, around 11.6 million barrels. A lot of this oil is actually exported because it cannot be refined in U.S. refineries. But that's a whole nother story. Oil is basically fungible, but different grades are used in different types of refineries. Most of the refineries along the Gulf Coast of Texas are set up to refine Venezuelan and Mexican heavy crudes. So enough to say that sentiment gets affected, though. When you have headlines that the U.S. is now the largest producer and you couple it with some of these other reasons, it helps to create a bearish sentiment. That's basically what I want to say. The second reason of the confluence of events is that we're in the shoulder season. What's the shoulder season? Well, that's the end of the summer driving season and the time period where you enter into the heating season, where heating oil is made and demand for gasoline goes down. It's also the time when refineries go into turnaround. We've talked about that before. Those are maintenance activities that take place in the refineries that they have to go through those. And obviously, when you're in turnaround, the refinery is not operating at its maximum, or if at all, it may be completely shut down, or some of the units may be shut down. Suffice to say, it's not processing the same amount of crude as when it's operating. So this particular refinery turnaround season took about 50% more crude offline. Typically, you would see 700,000 barrels per day of crude draws to refineries be taken offline during turnaround. This year was 1.2 million. So you had another 500,000 barrels per day of production taken offline for turnarounds. And that is another of the events that backed up oil in Canada. Now they have this huge backup of heavy crude and oil in Canada, and it's really knocked the price down. That's sentiment strike number two. This one, the third one about the world economy slowing, there's a narrative now that the world economy is slowing, and there are some regions that are slowing, and that demand is set to decline. They have to be careful with this because the IEA, the International Energy Agency or administration that does the forecasting for demand, has not been reliable in its forecast. It's constantly underestimated oil demand. And I would suggest to you that if you go back and look at a chart of oil demand, even in 2008 when we had the great financial crisis, oil demand did not decrease that much. I mean, suffice to say, guys, if you put a Chinese or Indian person into a car, they're now a gasoline consumer. People are making the transition to urban areas, requires more transportation, more bringing of goods in, farm food, these type of things. So continued industrialization and urbanization is going to continue to drive oil demand higher. So I would be careful when, even we'd have to have like a worldwide depression or big consistent economic declines or decreases around the world to really see oil demand get really impacted severely. And I think the main reason, we had all this negative sentiment building around this oil price. 1 week we're going to go to $100 a barrel, and then within a span of 2 weeks we're going down to $40 or $30 a barrel. I think all these things that I mentioned already turn the sentiment from bullish to bearish, but I think the main thing that really got things moving to the downside is when Donald Trump double clutched and sold out the Saudis on Iran sanctions for midterm election benefits. I mean, let's face it, the oil price, I mentioned this in a video back in the summer, where when these stupid sanctions were even announced, and I said that Donald Trump was being myopic in that we had a congressional election coming up, and that the oil markets were so tight that the removal of 1 to 2 million barrels of Iranian crude could cause an oil price spike right around the elections. So in his, whether he did it in back channels or directly or via tweets, whatever, he indicated to our allies in Saudi Arabia that you know, they should increase production to compensate for the Iranian crude. So let's just go through this Iran sanctions slide if we could. Back in May of 2018, the U.S. administration announced new sanctions on Iran. They were going to force 1 to 2 million barrels of production to be taken offline. Now, again, that was in a context of a very tight oil market that we already had increasing prices and lowering inventories. That was the story all through the spring and summer. So as you can see, the next blurb here on the slide, inventories continue to decline and prices continue to rise. The Saudis responded to U.S. requests to fill the gap, the anticipated gap, and along with other smaller producers, i.e. Iraq, UAE, or even Russia got in on it, they increased production by 1.5 million barrels per day to compensate for the anticipated reduction in Iranian crude that was going to take place on November 5th. So this changed the declining inventory situation and moderated it. It was still declining slightly, but leveling out. Then, you know, a few weeks ago, the oil, or longer than a few weeks ago, the idea was floated that, you know, we had these various allies that are oil consumers: South Korea, Japan, India. I think there's 8 total countries included in the waiver program, which basically negated what the Saudis were doing. And now that really was the final, if you will, domino to fall in the sentiment turning from bullish to bearish. And when we had this sentiment change, you know, in the context of world economy slowing down, less energy demand, crude backing up in Canada, now the Saudis are producing the Saudis and their other allies are producing 1.5 million barrels more to compensate for Iranian sanctions, and now there's not going to be any Iranian sanctions. So that was enough for a big liquidation to take place in the oil futures market. And then to put the cherry on top, there was a story out there that there was a hedge fund, a pretty big fund evidently, that was long crude oil and short natural gas. Well, we've seen the exact thing opposite happen. We've seen natural gas up like 60% in the last month, and we've seen oil prices start to go down. And then you know how this works. A lot of these hedge funds are using leverage. They have to begin liquidating, selling into a declining market. Then the other hedge funds and opportunists come in, speculators, the AI and the computers take over, and it turns into an avalanche. And that's what we saw. We just saw selling, indiscriminate selling, straight down, like at a 45-degree angle, which is just not indicative of how a market really would work. It's a unique confluence of events, and it's unprecedented. I have never seen anything like that, at least in the oil market. I mean, we see these things happen. So, as we say right here, this caused a change in sentiment, and long contracts were liquidated at an unprecedented rate. If you've been following the news, you would note that the Saudis have already pledged a 500,000 barrel per day cut in production, and I believe more is coming. As a matter of fact, if you look at, there's people that I follow that track these things, and you've already seen the amount of crude loadings heading to the U.S. from Saudi has declined massively. So they've already started cutting production. It is not in the interest of the Saudi government, Kingdom of Saudi Arabia, to have oil prices at $40 or $50 a barrel. It is not in the best interest of the Russians to have it at this level. So I think Donald Trump double clutched the Saudis, a so-called ally, for his benefit. He wanted low oil prices. They did not want high gas prices going into the midterm election. They had enough problems, Republicans did, in trying to maintain what they had. The last thing they needed was $4 a gallon gasoline. I think he sold out the Saudis. You get to do that once maybe, and I don't think that they'll fall for that again. I think that, I don't know the intricacies. I'm not plugged into the political inside, but this looks like is what happened. And that's how a guy like Donald Trump operates. He doesn't really care about long term. He's going to do everything that he needs to do in the short term to keep the balls in the air. That's what he does. That's what he's done his whole career. Read the art of the deal. He's successful at it. The Saudis have to get away from an oil-based economy. They're making huge investments. They're planning on building nuclear power plants. They have a very restive or a population that is really primed for unrest. They need to create jobs. They're building this new city in the desert, $500 billion. They have got a lot of bad press recently with the Khashoggi thing, and they are not, I don't think, too happy right now. So I think that that's what happened. It's water under the bridge now, but this is what creates opportunity for speculators. So let's look at a couple of charts. So even with all of this, this is a chart of OECD inventories. When we talk about OECD, that's the Organization for Economic Cooperation and Development. Basically, these are all the developed countries, United States, European countries, Japan. And these are the oil inventories relative to the 10-year average. And you will note the last readings were in August. That's the last data that we have. But they were already pretty low relative to the 10-year average. So even with what shale going to record high production in the U.S., even with this situation with the Saudis and the Iranian sanctions, and the Saudis getting double clutched, we really haven't seen a huge spike in inventories worldwide. And I think that's what happens. I mean, these markets are very driven by news, day-to-day news, not long-term news. And here's the facts. The facts are that the inventories have barely started growing. So we're still in a precarious supply situation if you want to look at the facts. There's a difference. I've said this before. There's a difference between financial oil, paper oil, and real oil, physical oil. And physical oil, is direct. The price is directed long term by inventories, production, supply, those type of things. Paper oil is futures contracts, and when you have massive liquidations, which we've seen, I pointed that out in a previous video, I think a week or two ago, the most oil contracts liquidated in the shortest amount of time ever. Of course, you're going to have a crash in oil prices. I mean, we've talked about computers and artificial intelligence, and this stuff is automated. Once the momentum changes to the negative, they all go short. And especially if you've got a hedge fund that's caught out, like one was evidently, they're forced to liquidate into a declining market. It's just forced selling. So let's check out this next slide. Here's what I think is interesting. So here we have, this is basically the weighting of energy in the S&P 500. And what you're seeing here is that energy equities, which energy stocks, if you will, are at an 18-year low relative to the S&P in their weighting. So they are the most basically out of favor they've been in 18 years. They have the lowest weighting inside the S&P. Now, oil is basically, oil and petroleum products are all around you. They enable civilization. I love having arguments about people about electrification and all this stuff. Basically, oil enables you to live not like a hobbit scratching an existence out of the dirt with no light, no heat. I mean, oil is, what greases civilization. So when we see energy equities at an 18-year low relative to the technology and everything else in the S&P, with the long-term fundamentals in place, I think that that's something that we have to sit up and take notice of as speculators. And we've been on this. I mean, it was low even, we've been talking about this for 6 or 8 months. It was already at historic lows, and it's gotten even lower. I mean, you've had the lowest valuations I've ever seen probably in this market. So what does it mean? What is the bottom line here? The sell-off in oil has been extreme and indiscriminate. Everything got sold. Everything just get me out, get me out. The economy's going down. Jim Cramer said oil's going below 40. Just sell everything, get out. I didn't sell a thing, and I'll tell you why. Long-term fundamentals are still intact. There's been no surge in new investment in reserves and new supply. There just isn't. I mean, with the exception of what's going on in the shale basin, basically the Permian. Let's put shale oil into perspective, guys. We have U.S. production at 11.6 million barrels. I'd say 6.5 to 7 million barrels of that is shale oil. So out of 100 million barrels a day in world demand, 7 million barrels is coming from new shale. Now, with the decline rates, with the amount of investment that's needed, how do you increase production? Are we going to double production to 20 million barrels? I guess it's possible, but how do you do it with those decline rates? You have to drill twice or 3 or 4 times the amount of wells and get the product out. We've already had conversations in previous videos about how in some of these shale basins, the original sweet spot parent wells are in decline, and now the oil companies, the producers, are having to go out to what they call the child wells, the second and third tier wells, which are not as prospective and not as producing as much. I mean, it is what it is. That doesn't mean that shale is going to collapse, but I don't know if they can go to 15, 20 million barrels of production. Maybe they can. Technology continues to advance. But remember, 100 million barrels a day of demand is out there every day, and it's growing by 1 to 1.5 million barrels a day per year. So you factor in a worldwide overall decline rate of 6%, you add 1 million barrels of demand growth a year, you still have to find another 7 and bring online another 7 million barrels a day of production every year. So shale isn't going to do that by itself, and there simply hasn't been any non-OPEC, non-shale increases in capital spending. The oil companies are simply not having an appetite to spend huge sums of money on legacy huge projects, even if they exist. So I think this is what sets us up for a long-term bull market in oil. Like I said, the Saudis have cut 500. They've already cut 500,000 barrels. Their crude loadings are already showing that they're cutting back. You got to remember something. They ramped their fields up to like 10.5 million barrels a day. You're talking about oil fields in Saudi Arabia that are 50, 60, 70 years old. They are very, very worn out. They cannot run at that level without the possibility of damaging the structures in the well, in the formations. So they can temporarily run at these high levels, but it's in their best interest to throttle back their production, and that's what they're going to do. We are allies with them, supposedly. They are neck and neck fighting with the Iranians. We've talked about that before. They thought they were helping out the U.S., which is one of their backers, and they got double clutched. We'll see how that pans out over the next couple of years. Like I said, there's a December OPEC meeting. I believe that the Saudis have already indicated they're going to push for another 500,000 barrel per day cut in production. They'll probably get it. And we'll have to watch oil inventories, and they should resume their downward decline and cause prices to rise. Although shale production continues to grow, I don't believe it can continue at this pace. I mean, maybe it can. Maybe the technological advances are so great, and I'm really underestimating the amount of oil that's really in place that can be produced. But you still have declines. You still have to, you're kind of in that Red Queen's race. The higher the production goes, the faster you have to drill to not only compensate for declines, but to increase production. And at some point, you're not able to overcome that. And this is the bottom line, guys. This is an example of contrary investing or speculating. We talk about it, theoretically, and, on these videos, but this is it. This is an opportunity. And if you've analyzed it, and I'm not just talking about listening to me, I'm not saying I'm some guru that everybody should just listen to. If you have analyzed this, if you understand that billions of dollars have to be invested every year, or you're not going to be able to increase production or maintain production, and you understand that that investment has not taken place, you don't care about a month or two decline like this. You care about the 3 to 5 year modeling. I mean, a crash in oil prices, does your thesis override your nerves? I can understand somebody that doesn't understand the supply-demand dynamics, the amount of investment required, the fact that we haven't been investing. You know, it's just saying, get me out of this. This guy doesn't know what he's talking about. He's nuts. I'm out. Or I've been stepping up and buying because I think I understand this. Now, I could be wrong. You know, we could go into a worldwide economic crisis. Oil demand could plummet. The price could decline. Shale could maybe go to 20 million barrels a day. I mean, anything's possible. But the fundamentals and the facts that we've been looking at over the last couple months really haven't changed in the last week or two. So, you know, I'll give you an example. We have a stock in the portfolio that's an oil service company that's based in Norway. And even with oil prices when they were down, even with no investment going on, the company's assets are only at 40% utilization, and the company's still making money and cash flowing positive. What happens when they get full utilization, or they get to 70 or 80 or 90% utilization of their equipment? What happens? Like I said, they're running at a 40% utilization rate right now, and they're already still cash flow positive and profitable. So there are companies out there like that are already have cut everything to the bone and are surviving and making money at these oil price levels and these low capital investment levels. I would suggest to you that every day that we don't invest enough money, at some point we're getting closer to an oil price spike. So that's the thesis. I've talked about it enough. I'm happy to engage in the comments section. Everybody has their own opinion. Like I said, I'm not a guru. This is what I'm doing. I've been buying some of these stocks at basically all-time lows, and I think I'm right, and we'll see what happens. Okay, that's it for this week, guys. We got the Thanksgiving holiday coming up. Time to just decompress and spend some time with family and friends and give thanks for the blessings we do have. So I wish everyone a happy Thanksgiving, and I will not have a show this weekend. I will not have a video because I'll be spending time with family and traveling, but I will be back online the following weekend, and we'll be picking it up where we left off. Until then, happy holidays, and we'll talk to you in 2 weeks. Thanks, guys.